That was Greg Abel, the CEO of Enbridge, talking to our Bloomberg partners. Let's get more on this stock now from Aaron MacNeil, research analyst at TD Cowen. Thank you very much indeed for joining us, Aaron. You have a buy on Enbridge. Tell us what attracts you to the company.
Yeah, I think obviously you can start with the dividend, right? It's pretty competitive in the context of large caps in Canada. We actually did a bunch of work on this, and we looked at every large cap in the S&P TSX Dividend Aristocrats Index, and Enbridge would have the third highest yield among those companies behind Bell and TELUS. I'm obviously not a telecom analyst, so I'll refrain from commenting on that. But what I would tell you is we view Enbridge's dividend as sustainable. We view its dividend growth rate as sustainable. And so, when we look at long-term growth rates for Enbridge's dividend, which they've guided to 3%, that would be pretty competitive in the context of those other large cap dividend aristocrats. We looked at, over a 10-year time period, what those companies would have to grow their dividend by to be competitive with Enbridge's yield. And in all cases outside of energy, they would have to grow their dividend at a much higher dividend growth rate than historical. And then you layer on the growth of the business. Obviously, we've got, very good visibility on growth for conventional energy infrastructure, multi-year growth. That's changed from recent history. And so I think the setup is really good here.
So the yield is about 5.9%. So I'm trying to think of somebody who put substantial money into the stock, hoping to reap dividend income outside a tax-sheltered plan. Did you say you're looking at roughly 3% increases in the dividend each year?
That's right. That's the guidance, 3% for the next couple of years. And then I think beyond 2026, they're talking about step-ups in line with cash flow, which I think their guidance is closer to 5%.
Where will they get most of their growth in years to come?
Yeah, well, right now, if you look at their secured capital pipeline, it's all on the gas side. And remember that Enbridge was historically an oil company. They've done some great acquisitions over the last couple of years. 2017, they did the Spectra deal. 2024, they did the U.S. gas utility acquisitions. So, they moved that commodity mix from almost entirely oil to 50-50 gas and oil. So again, you look at the secured capital, lots of growth on the gas side. I mean, there's, the data center dynamic. I think that's a nice to have, not a need to have. There's the LNG off capacity growth. There's coal to gas switching, just lots of power demand. But don't forget the oil side too, right? We're talking about capacity expansions to the mainline. It's full today. We're talking about growth in U.S. pipelines as well. And so I think there's lots of growth across the commodity spectrum.
It's interesting. Yeah, you mentioned their giant oil cross-border pipeline operations. Isn't Trans Mountain something of a threat to them in terms of potentially lost market share?
Well, again, we've seen that play out. Trans Mountain's active today, and the main line is in apportionment, meaning that there's more production that wants to go through the main line than they have capacity for. So again, I think the setup for Enbridge is very good. I think they've sort of proven that that infrastructure has remained resilient.
Maybe we could put up a 10-year chart for the stock, because I seem to remember, well, a few years ago, I think it's going back 3 or 4 years now, people were worried about the balance sheet or whether Enbridge was going to have trouble funding its massive expansion.
Yeah, for sure. And again, I think, there's a couple questions in there, but, we look at valuation on a 10-year historical range. We're back to, the 10-year mean today. The valuation in the last couple of years was a little depressed given the terminal values or people questioning the terminal values of conventional energy infrastructure. And I think that's proven to be much more resilient than people thought. On the capital structure, I mean, we've got, they are a utility-like business, and in order to maximize returns for their shareholders, they have to layer in that new debt with new assets, or else they're just not going to get the return that that's specified by those ratable contracts.
Aaron, thank you very much indeed for joining us today.
Yeah, you bet.